Tokenized money, the agentic world, the future is here and it's not evenly distributed. That's a cliche. And I have with me today Nik Milanović to talk about these topics that are top of mind on everybody's book these days. Nik, let me welcome you before I introduce you formally to our audience. Thank you for joining us.
Thank you, Dr. Pilarinu. I really appreciate you having me on the show. I've been a longtime reader and follower of yours. I think I've been a LinkedIn follower for something like a decade now, so it's great to finally talk.
A decade. It's over a decade that I've been in fintech, and the early days were different, much more concentrated. I always feel that at that time it was just the startups that were innovating, and now it's everybody kind of thing. The borders have opened. It's not only the startups. Some of them are not even startups anymore. We have all these hyperscalers. We have the incumbents innovating. We have big tech companies. We have non-financial services companies. So the space has grown a lot. And your journey is very interesting. I guess we can safely say that you come from the payments world, that you started this week in fintech when you were at Pedal. Is that correct?
That's right. That's right. You know the whole backstory.
So that's quite a while, I must say, and you have grown that community to over 200,000 subscribers globally, North America, Latin America, EMEA, APAC, and right now we all know that you just sold the business to Plaid, and we'll have the opportunity to talk about that, whether it's Plaid or Plaid, depending on whether you're American or British. And you are the founder of Stablecon. And Stablecon ran its first EMEA event just recently in May, and we'll have the opportunity to talk about it. So shall we start a little bit with some color about the recent news of Plaid acquiring this week in fintech? What does that mean for you and for this week in fintech?
Good question. And thank you for having me on the show to talk through it. It was a surprise to me. You've been doing this longer than I have, and I think it's really interesting building out a B2B media business because you've seen fintech grow around the Fintech Conversations and Insights podcast that you put together. Like you said, it was all startups in the past, and now I would assume that in your audience of 200,000 LinkedIn followers, you probably have a lot of bankers who have been taking cues from what they've learned in your interviews and your writing. And we're just in a different world in fintech than we were. And so I started This Week in Fintech not as long ago as you. I started 7 years ago in August and never really had any intention to sell what became a little bit more of a media org. So it really started as just one newsletter. And now we have 50 people on the team doing a variety of podcasts, of newsletters, of breaking news reporting. And the Plaid team reached out about half a year ago and said that they had this vision to build a news network focused on fintech that really increased the quality of news coverage for stories happening across the financial technology space. And that's something that's really aligned with our own vision. I was surprised. I didn't think that there was another company out there that kind of shared this vision to build a news network around fintech. But as we talked more and more, it felt like there was a really good fit here. And I think the model that I think about, which also resonated with Zach Perret, the Plaid CEO, is like a Bloomberg Business Week, where you have Bloomberg and you have Business Week, and the properties benefit from each other, but they're two separate companies. You have a software company and a news company. And so my hope is as we grow our breaking news and as we launch video news, that we'll be able to hopefully benefit from collaborating with great creators and intellectuals in the space, such as yourself, and that we'll have a lot more of these conversations going forward.
Yeah, and I love the idea. I come from that background. I started by blogging on Daily Fintech, which was a multi-author platform with a lot of leeway for each of us to express what we found interesting and what our insights, because everybody comes from a different background. And especially these days with all these changes that are going on. Nobody can know everything or even keep up with everything, let alone form an opinion. So I believe in collaborations and bringing different minds together to really form a puzzle and a picture of where we're heading at, a bit of a foresight, if you want, in this very complex and uncertain world that is not going to stop accelerating no matter what, whether it's the innovation, whether it's the tech that we're building, the regulatory frameworks that are shaping the dominant business models, because that's the reality that I think will never change. So it's really an exciting time to be in this space. And as I mentioned before, I think there's these two huge trends, transformational trends from the bottom up at the infrastructure level that are happening. One is the whole world of the agentic economy, the primitives that are built there, and how we in financial services are going to support that economy. And then there's the tokenized world that is much more important to financial services, in my opinion, to capital markets and the B2B world more than the B2C world. So tell us, from Stablecoin that you recently hosted, what surprised you? Because this is the first event in EMEA, and EMEA is a very different region than the US. You've been running Stablecoin there. What really surprised you, if anything, from what was discussed, the energy, the atmosphere, the announcements? What can you tell us?
I can tell you that I would love to have you on stage at the conference next year to present your own findings and takeaways. I know that you were formerly a professor, and I think that we would really benefit from some of your perspective on stage at Stablecon EMEA next year when we get the
Yeah.
conference up. It's interesting. I think we had three main takeaways from the EMEA conference, and the background you gave is perfect. But to add a little bit of color, we organized our first stablecoin conference in 2025, based in New York City. We brought together 1,000 people from the stablecoin industry, which is growing incredibly quickly as a space within fintech. And we decided to branch out into EMEA because what we found is that we had a lot of people who flew into the New York conference from the Gulf, from Nigeria, from Kenya, from London, from Paris, from Berlin. But these ecosystems are very different to the US ecosystem. And so those conversations need their own space. And that's why we decided to launch the EMEA conference. I think that there were three interesting takeaways. One is that even on a country by country basis, you have radically different customer tastes and preferences. And what is important to business customer in the UK, now that the UK has gone through Brexit and correspondent banking is a little bit more difficult with Europe, is going to be very different from what customers want if they're using a stablecoin platform in France, where they're trying to pay a supplier in Berlin. The second piece was that, and as Americans, we think about like homogenous use cases, but I think that you actually have a big fragmentation of customer needs. The second was that from a regulatory perspective, everybody is paying attention to what's happening with the Genius Act and Clarity Act in the US, because there's an expectation that other regulators will probably implement similar structures when we have, quote unquote, clarity around what the US regulatory structure looks like. And the idea is that there's so much economic activity centered around financial services in the US that if you have companies that are set up to operate in a way that's compliant with the US, you have regulators, for instance, in Latvia and Brussels, who will decide, okay, we're going to have a similar system so that we have the same banks that are able to issue in the US and issue in Belgium and Latvia and Sweden and so on, without necessarily needing to re-architect their entire system. And then the third, and this is similar to New York, is how young the space is and how quickly it's growing. And so you have a lot of companies based in Paris, based in Amsterdam, based in London, whose primary customers are not necessarily operating under MiCA in Europe. And so they're going out and selling to companies in Israel, in Dubai, selling to customers in Nairobi, in Lagos, in New York, of course. And the expectation is that the regulatory climate in Europe, and MiCA specifically, are going to, over time, enable more innovation within stablecoins, but it's not just there yet. And so companies are taking the initiative to really become international first, which I think is going to give them a huge advantage when there is a more favorable climate in Europe, because they'll develop so many learnings by becoming international first.
Yeah, yeah. And it's interesting because we have seen that the world is split between activities that are unregulated under certain regimes and others that are regulated under certain regimes. And you see a split where these corridors are working. I would say what has surprised me this year is that it seems that over 90% of the large banking players either have some project going or are already into a project that has to do with tokenized money. I don't want to say stable coins because I want to put it as tokenized money because it includes also tokenized deposits, right? And we have seen a lot of activity there, especially recently. I would say the last 3 months, it's been amazing announcements and the activity that we are seeing from banks. One of the arguments that you've been making is that stable coins and cards can live together, and because others say it's either stable coins or cards, or and especially here in Europe we have this sort of wishful thinking, if you want, or dream, however you want, depending on the geopolitical color that you want to give to it, that stable coins will free us from the dominance of the big card networks that are mainly US based. So they are a solution to that rather than really a technical problem. And there's other initiatives in Europe that are trying also to do that, be it the Vero wallet and so on. But tell us your opinion and your line of thinking about this topic of stable coins and cards and why you see them coexisting.
That is the dominant question this year, especially because stablecoin card companies, stablecoin backed and stablecoin linked cards have really taken off. You look at providers like Rain, like we, Coinbase launched their own stablecoin backed card. This product type seems to be really growing. And so a lot of crypto, like hardcore purists, are asking, oh, well, why are stablecoin linked cards a product at all? Like, why don't we just bypass cards entirely and focus on stablecoins? I think that question misunderstands the competitive advantage of stablecoins as a product. Really, what you're talking about with stablecoins, you're talking about a rail, and it can be a settlement rail, it can be an authorization rail for verifying identity, it can be a money movement rail for being able to pass money and flow more quickly between counterparties. It could be a ledgering rail, where really what you're just trying to understand is exactly like where every dollar is. There are a lot of different use cases for that rail, but ultimately stablecoins are back-end infrastructure. And so the use cases are going to vary. And you can power card functionality on stablecoins just as well as you can power peer-to-peer payments. It's just a different way of leveraging that rail. And companies like Rain are doing really interesting things where they are facilitating credit development on chain. And so they're able to draw down against reserves in order to lend on chain. They are providing issuance in multiple countries based on stablecoins, where normally you would have to work slowly to get an issuance product off the ground, country by country. They're just partnering in order to be available in 100 plus countries immediately. MasterCard, Visa, working on these proof of concepts on issuance internationally, and it's growing just really fast relative to the work that companies like Marqeta or Galileo as issuer processors did in the past. There's so many other facets of stablecoins, like being able to secure a charge card against a digital wallet balance that can automatically be drawn down, that are interesting and I think still underexplored. Being able to give proactive rewards based on micropayments made on websites if you have a browser integration that leverages stablecoins. But as you mentioned, Europe has Wero, the Unified Digital Wallet Initiative of the EPI, and has the quote unquote payment alliance that includes Bism and Wero and Vip's Mobile Pay. And the idea here is that Europe needs to create a compelling challenger as a card network to Visa and MasterCard. This seems really difficult. Like Visa and MasterCard are entrenched networks that
They are
benefit from network
friends. Yeah,
effects.
yeah.
But at the same time, you have UnionPay in China, you have other card networks that have been able to create good regional dominance. And I think that it's not impossible to create a challenging competitor network to Visa and MasterCard to bring back some sovereignty to European payments. And I think that stablecoins will just be a big piece of that. And so whether you're talking about credit issuance, which is more popular in the US because you can have a higher interchange and pay rewards, or debit issuance, which happens to be more popular in Europe because of interchange rules, stablecoins will probably play a role there. Whether it means that you can pay down your balance in real time and see it automatically adjust without waiting for the bank transfer, whether it means that you can take out like a short-term loan against your credit balance if you are running up against your card limit, whether it means that you can secure a purchase by pledging stablecoins in a wallet against a credit card purchase that you're trying to make that falls outside of your normal available credit limit. There's a lot of functionality to play with there. And so I think stablecoins will actually level the playing field, where I expect to see a lot more card-based innovation coming out of Europe.
Yeah, yeah. And we have Vero coming up, but it needs adoption. It's there, it has started, right? But until the last mile actually happens, it might take time, right? Because you have all these countries that actually, many of them have really great real-time payment systems domestically, and therefore incentive to adopt Vero is not clear. It's not so easy. We all know that the technology might be there, but how do you get people to change their behavior? As you said, these big card networks are entrenched in our lives, and we are not rational economic participants. That's always the issue with all economic models or thinking, and even businesses that go to market and say, okay, we have this great product, it makes sense, economic and so on, but we can't get people to use it behaviorally because we are not optimizing all the time. Maybe when we get that agent, it will happen. But for now, we are not rational 100%, right?
No, Homo economicus does not exist in real life. And I
Exactly.
think that's a mistake that many people make when they look at fintech as investors, as product builders, as founders. At Google Pay, so I was head of business development for Google Pay in the US in a past life, and we wanted to make the Google Pay wallet a dominant payment method and to make mobile payments take over from plastic card payments. And the idea there would be, okay, you have a wallet, and so you have a stored credit balance, and you can just bypass cards entirely. But what we found is that people use Google Wallet primarily to load in their credit cards and then do tap to pay. And the use of the credit card is just such a sticky user behavior that if you're building a stablecoin product and you want to fight against credit cards, right now that's a losing proposition. People are conditioned to using cards. It's a really great product. It's a piece of plastic in your hand that works almost anywhere to make a purchase. It's hard to get much better than that. And if you're doing 2FA authorizations to get into your wallet balance in order to enable a payment that's going to drain your balance now instead of in 30 days, it's just not a better value proposition to customers. People aren't going to make a rational decision there. And so to your point, you would think merchants in the US would say, okay, I'm paying 3% on my cards right now. So instead, if I enable stablecoin payments, which will settle for a cent versus on a $100 transaction, it might settle for 1 to 2 cents instead of $3. For me, that's a much better idea. So I should incentivize users to go over to stablecoin payments. Maybe I can give some rewards, and I'll basically pay 1% rewards to customers that check out with stablecoins. From an economic model perspective, it makes sense. You're cutting deadweight loss.
They could
Merchants save
give
money, the users.
50% of that 3% back to customers as rewards,
It
right?
makes so much sense. And nobody does it. Nobody ever does it. It never has been successful.
Yeah, yeah. Isn't it amazing? I think that is a point that when you're designing customer-centric innovation, you really have to understand the psychology and the behavior of customers. In your mind, Nick, everybody's talking about stable coins as the killer app for the do it for me economy, the delegate economy that's been built for us, and the machine to machine economy. So I look at them as two different ones, right? The delegate economy and the machine to machine economy. Do you buy this? Do you think that stable coins are absolutely necessary for this, or do you think that we will find other ways to deal with the especially with the delegate economy. I can see the machine-to-machine economy, especially anything to do with micropayments. I expect, I would say, explosive volume of that, payments in the order of, I don't know, 10 cents or 50 cents. And there I can only see stable coins or some other on-chain way to do this. But everything else, I have a question. Who knows? What do you think?
Before we jumped on the call, you were talking about the convergence of AI and stablecoins, and I think that that is still an underexplored topic, although it's really a bigger topic this year. And I do think that these areas are going to converge in financial services. And so, as you mentioned, there's the delegate version of financial services products, and then there's the agent to agent version or the automatic version. I think you're seeing a lot of really interesting companies innovating in that first column today, where the idea is the human is in the loop, but I express my desire to an agent that's able to go out and execute that transaction for me.
Yeah.
And to your point, it still means that we're going to make some kind of non-economically rational decisions because effectively we're just giving instructions to somebody who's going out and executing them on our behalf. The more interesting future vision of finance is in that second column. And it's what Lex Sokolin over at Fintech Blueprint calls robot money.
Yep.
And that's when you really have systems that are not designed for human users. And so there's no consumer facing website, there's no dashboard, there's no buttons. It's a headless product that's primarily designed to enable financial services transactions between computer algorithms. And that to me, I think is going to be the future. And it looks a lot more interesting, but it will take a lot of trust in order to be able to get over there. So you can see all these banks doing proof of concepts with stablecoins, but the trust needed to move your critical architecture over to an agent, over to a decentralized payment is not there yet. We'll get there, but it's going to take a while. And so conventional rails, PIX, UPI, SPAY, RTP, none of this is going away overnight. These are pressure tested rails. It's going to take a while to move to stablecoins. But this is a long way of getting back to your original question. I do think that stablecoins are going to be critical for that second column of the human out of the loop robot money agent to agent transactions. And the reason I feel that way is because you think about in music, you think about old records, vinyl records. You have a vinyl record and you put it down on a record player and it plays a beautiful song. But if you were to pick up that record and try to pull apart different pieces of the music, it would be impossible. It's encoded on this plastic. It's not something that you can break apart into components. And then you had CDs. And what's interesting is if you look at CDs, you're able to put a CD, it's digitally encoded, and you're able to put a CD into a computer and pull apart the master. You can pull apart individual tracks, you can pull apart the master track, you can pull apart individual sounds, you can pull apart individual
Very
instruments.
very modular architecture.
Yeah. Exactly. And that's, I think, the transition that we're going through with stablecoins, which blows my mind because CDs came out 40 years ago and now we're just doing that with money. But what's interesting is if I'm in the US and I set a transaction, even an instant transaction through FedNow or RTP or an ACH transaction, there's times where I don't know where that money is. It's in flight, it's in movement. I don't know if it's been rejected. Yeah. Exactly. Or if it will be rejected, or if there's an insufficient account balance on the other side. And so it's a little bit like the record where you can hear the music, but you can't break apart the data. Stablecoins allow you to actually break apart the data because everything is digitally encoded. So you can add messaging, you can understand real-time balances, you can understand where money is in flight. To me, I think that's necessary architecture for those robot-to-robot exchanges.
Yeah, yeah. Nick, we unconsciously talk about dollar stablecoins just because the dollar is the reserve currency and 99.99% of stablecoins are pegged to the dollar. And if what you say is true, whether it develops in 3 years or 5 years to an extent that is at least meaningful, and we don't call it emerging, we need non-dollar stable coins because that activity can't continue to be only in US dollar stable coins, except if there's a conspiracy theory out there that, yes, that is the way that one way that the US dollar will remain payment by dominant by really being critical if you want, or dominating 90% of this new economy, the delegate or the machine-to-machine economy. What are your thoughts? What are you seeing? What are you hearing about that? We've seen in Europe how difficult it is to get a euro stable coin that is, I think we have only one, the Euro C by
By
Forge.
Circle. Yeah.
Yeah. And we're talking about the second largest reserve currency, right? We're not talking about the Brazilian real or the Indian rupee or whatever other currency exists out there. What are your thoughts? What are you hearing from Stablecoin, from your network?
That is the number one question to ask. And I think that nobody knows the answer. You have these dorm room conversations that you have when you're in college, where you're talking about kind of the great questions of the 28th century. Was communism destined to fail, or was it just situational based on the circumstances at the time? And I think you have a similar question that's emerging in the stablecoin space today, where people ask, does stablecoins mean that we're going to converge on a single currency, or are you going to have multiple different reserve currencies with big liquidity and financial regimes all under stablecoins as well? And nobody knows the answer. People will tell you they know the answer. Nobody knows the answer. I think if you set aside stablecoins for a second, over time, we are seeing that there is more convergence into dominant currencies and reserve currencies in international markets. And this is happening because you have increasingly globalized markets, globalized capital, globalized labor, and globalized trade and products. And
And the
so,
liquidity begets liquidity. So it's
exactly.
a reinforcing mechanism. Yeah.
And smaller currencies, their relative balance in global central banking and trade is diminishing. And it's not an exciting prospect for instance, South Africa to know that they're going to be primarily transacting in dollars or pounds or euros, and that rand is not going to be a hot international commodity. But there are a lot of benefits to the system. You are able to continue growing a globalized economy much more effectively. If you're Zimbabwe or Turkey or Argentina, you're able to offset your own currency instability with reserves that provide a little bit of stability to you. The trade off is, of course, sovereignty. And it means that as a central bank, you may not be able to act to your country's specific economic conditions in a way that lets you leverage interest rates in order to fight inflation or fight unemployment. That is a big trade off. And so I think it's creating a lot of anxiety with central bankers globally. But that's happening without stablecoins. Then the question is, what happens if you map stablecoins onto this? The American perspective from the administration is we view stablecoins as like a buyer of last resort for US treasuries. And so US debt is reaching all-time highs, and stablecoins are this welcome innovation to find additional buyers of US treasuries in international markets.
Although it's very confined to the short end of the yield curve, right? Which is also something very new, because typically the US yield curve was more about financing through the medium to longer term. So who knows the effects, as you say? That's a PhD for an economist.
Yeah, and there are some uncomfortable political questions that are wrapped up into why that yield curve inversion is happening, but we won't go into that.
Yeah, we will not. And Nick, let's touch on the other sensitive topic of tokenized deposits versus private stablecoins. And we're not going to touch on central bank digital currencies. What was the pulse at Stablecoin with regards to that? And I am more interested, we're seeing real activity happening with tokenized deposits. Is it real? When I walked around Money 2020 this year, which by the way had more about tokenized money than ever, right? I heard around the cooler that, okay, Kivales, okay, but there's
Mhm.
nothing really happening. There's different voices. Some voices are really excited about the specific project, and others are not. Are tokenized deposits really happening? We know that Citi is really big on that. What are you hearing? What sense did you get at Stablecoin?
Um, I think the question comes down to the incentives of the different players in the space. Kivalis is a great example. Kivalis recently announced that they have 30 bank partners that are signing up with them to issue tokenized deposits that are bank specific. And the question is, why do they have these partners? Banks, similar to how they did in fintech, want to make sure that they retain their brand and their franchise value. It's always possible for a bank to become background pipes or infrastructure where you don't retain the customer relationship and you're disintermediated from the customer by a good UI. I think that there's a worry with stablecoins that you're going to see a similar situation where there's deposit flight out of banks into wallets,
Yeah.
where people are choosing to hold stables instead of holding deposits. And banks want to make sure, again, that they don't become just pipes or that deposit accounts go away entirely. And it is a compelling anxiety. And so you're seeing banks really push for tokenized deposits because it's a way to cement the bank as in its central role in financial services, where all money ultimately runs through a bank account to its final destination. I think if you were building a financial system from scratch, you would not necessarily design it around banks. Banks have been the conduit for consumer financial services forever, but it doesn't necessarily mean that role is necessary in a world where you actually have digital blockchain payments because you're fundamentally removing the need for kind of one central intermediary to sit in the middle of a transaction. And I think that scares banks and I think that scares policymakers. And there are good reasons to be scared. Banks play a lot of critical roles in the economy. They provide small business credit, they provide farm credit, they provide deposit insurance. And this is necessary to stability in consumer financial services. A stablecoin wallet's not necessarily going to provide that. You have everybody move money into a stablecoin wallet. Maybe small business loans go away. Maybe agriculture loans go away. Maybe there's a run on the bank or a flash crash, and it means that consumer deposits disappear overnight and there's no insurance policy. These are very scary policy considerations. And so I think you will see banks continue to compete to say, look, tokenized deposits are great because they apply the safety and soundness of the bank liability regime to digital currencies. And you'll continue to see stablecoin providers say, look, it doesn't make sense for people to have to move everything through a demand account. You can have a digital wallet here that integrates into any product that you're using, and you're going to be able to use money in a much more flexible way as a consumer. They're both good points, but it'll be a battle that happens for a while. And I don't think you're necessarily going to see private stablecoins or tokenized deposits go away overnight. It's just going to be a question of what actually people prefer to use.
Yeah, yeah.
What I would love to see is I would love to see a bank say, we're actually going to out innovate ourselves and we're going to launch our own wallet. And we are going to be a wallet first bank where most of our customers choose to hold their funds in a digital wallet rather than a demand account. I'd love to see a bank lean into that and actually solve the innovator's dilemma that way.
But they'll have to get to convince the regulators to license them, right, with that setup. I'm sure we're going to see a lot of innovation of new banks, whether they are agentic first, what their core will look like. We've seen some built on tokenized rails, but yeah, I only here in Switzerland we have 2 fully licensed banks, and they're very particular in the way they operate. So we have a long way to go. I'd like to see tokenizing deposits as a service for banks because look, the big players, the Citibanks of the world can do this. They have the teams, the know-how, that it makes sense for them. What about the medium and small banks? They need to have that capability should they choose to have that. So we need to see that also being built out. I don't know if you're seeing innovators doing that, but I think that it is something that is needed in this market to have a level playing field, even if we expect further consolidation in the banking industry, which is not a good thing for anybody, but trends, we're going through these trends always, right? Dations, unbundling, rebundling, and so on. Nik, we could talk for hours. Obviously, there's so many topics. Before closing, I want to ask you what is on your top of your mind, like you can't stop thinking, both professionally and personally, separate. I hope that they're separate topics. What is really top
They
of
are very
mind?
separate. They're very separate topics right now. I think top of mind is Personally, we just had a baby 2 months ago, and I don't think there's any moment outside of work that I'm not thinking about the baby. And it's our first baby, and it's been
Oh,
incredible
wow.
just to see like him change like every single week. And so we're sleep deprived but happy,
I don't know
which I
if you
never thought I would
saw
say.
Steve Wozniak's latest talk at the, what's it called, at the university,
No,
at the graduation. And he said, he asked the questions, how long does it take to create and design intelligence? And the students were, it was a commencement speech. The word wasn't coming to me. And you know what he said? He said, it takes 9 months. A baby takes 9 months. And it is true. I think that it's the most magical experience. It's experiential. We all know it, but when you experience it, you see it's intelligence. We are intelligence, right? We're not machines. Let's make that clear. We are intelligence that is beyond a machine and beyond our body. And I think that you can feel that with the newly born, especially if it's yours.
it's true. You look at an LLM and human reinforcement learning, and you need 1 million instances of this is a zebra and not a horse to know that's a zebra and not a horse. With a kid, you tell them like 3 times that's a zebra and not a horse, and they're like, okay, I know what a zebra is. Now I know what a horse is, and that's
Yeah,
real
yeah.
intelligence.
And there's so much more going on that is in the invisible field. That's the exchange of energy between humans. That's a big thing. And what about your professional life? What's top of mind?
Top of mind for me is getting you to speak at the conference in EMEA next year. I would love to have you with us.
I'd love that. Yeah, and for me, this is the big topic on mind where the agentic economy meets the tokenized world. I'm really following closely what's going on in agentic commerce, not because I'm a commerce specialist, but historically, commerce is leading, and we in financial services have to adapt to serve, right? It also happened with e-commerce, right? Financial services had to make all these changes, the digitalization of financial services, because of the digitalization of commerce, basically.
You took the words out of my mouth. I think the most interesting trend right now is that so much information is still not digitally encoded. So much information is still offline, but we're seeing more and more of it move online and on chain. And so that tokenization of information is going to change the products that are available to us. What can you actually do when you're transacting if everything is digitally encoded in a way that you can easily understand things and create more modular transactions? It's a lot more than you've been able to do in the past. I think it's going to be really interesting to watch.
It is. And I go back to a decade ago when it was, for me at least, when blockchain really came into my world, right, around 2016, and through the ecosystem here in Switzerland that was very vibrant at the time. And it was the time where Ethereum foundation had come here. There was a regulatory clarity that allowed them to, there was really a deep ecosystem. And it was becoming clear to me that this is a technology that has the potential to change how we collaborate and organize. It didn't happen because it got hijacked by crypto trading and greed and profits and so on. But there's a lot that has been built in that direction. And I feel that now, with the convergence of these trends, the big trends that is happening, this potential will come back again. And we do have, again, the potential to change the way we collaborate and organize in business and economic activities across the world and in capital markets. That's what's exciting to me, and I hope it's for the better.
I hope we're having this conversation again in a year and we can just talk about how much has happened, but I completely agree.
Yes, every 3 months we could have a complete update, and what we said today may be old by then. Nik, thank you so much. Really excited to have had this discussion, and let's keep excited and watching this world unfold.
Can't wait. Thank you, Effie.